Welcome to the SNN Network Canada virtual event. I'm your host, Robert Kraft, and I'd like to take this opportunity to introduce our next keynote presentation for this event. It is titled Small Cap GARP and Unique Tax Loss Selling Opportunities in December 2021. And giving this presentation today is Ryan Irvine from Keystone Financial. And with that, Ryan, take it away.
Thanks a lot for having me again, Bobby. It's great to be back here again with you. I'm going to talk about tax loss selling, how you can take advantage of that, how it's a unique advantage or opportunity in your portfolio, particularly this year in December. We're going to start with a little bit of minutia, what tax loss selling is. Bear with me as we get to that. If you already know all about tax loss selling, I can't assume that you do. We want to go through that. We'll get to the stock selections and some of our opportunities that we have in this segment going forward. Now, tax loss selling, essentially, we're going to start by defining it. The last days of the years are here, and we're approaching the last chance to harvest those tax loss or capital losses for tax purposes in your portfolio. The practice known as tax loss selling or tax loss harvesting involves selling investments in a loss position to offset capital gains realized by other investments. In this case, the investments we're referring to are common stock. An example of this I'll give you simply. If you sold stock in ABC on the TSX for a gain of, say, $1,000 this year, also during the year in 2021, you sold shares in XYZ for a loss of $1,000, $1,000 gain, $1,000 loss. The net effect is that they offset each other and you pay no tax in a portfolio. Now, tax loss selling, let's just get to what it is. Simply, again, it is important to note that this practice has no effect on tax loss sheltered accounts such as RSPs or TFSAs in Canada. You already pay no tax on the gains inside these investment vehicles. Make a special note that tax loss selling is used in non-registered accounts, your regular trading accounts, to reduce capital gains or tax liability. However, even if you invest only via an RSP or TFSA in your Canadian account, you will still be able to take advantage of the potential irrational tax loss selling by other investors each December for your own potential gains. I will show you how to do that in a few minutes. Now, net capital losses can be carried back 3 years or carried forward indefinitely to offset net capital gains in other years. Also, sales of securities or stocks must be settled within the calendar year in order to offset capital gains realized in the same year or the previous 3 years. Now, the last day of tax loss selling this year in Canadian listed stocks is December 29th. Now, trades executed on the 30th or 31st will settle in January 2022, making them ineligible for tax loss harvesting in 2021. So let's make one last thing here. I want to make sure that you do not run afoul or avoid running afoul of the superficial loss rules in Canada. The Income Tax Act in Canada has special guidelines for the type of loss is known as superficial losses. These are rules meant to prevent tax avoidance and prevent the deduction of artificial losses. In this case, for example, selling a stock today, trying to book the capital loss and buying it back tomorrow. Now, to avoid running afoul of the superficial loss rules in the Income Tax Act, you must wait at least 30 days after the sale to repurchase the security. Finally, one would also violate the superficial loss rule if they bought the same security during a 30-day period beginning before the period, the year, and the end of the year. And yes, so what I'm trying to say is there's no way to get around the CRA in Canada. They're going to tend to get your hands on your loot. Now, tax loss selling in practice, let's look at it here. If you have significant capital gains in 2021, you may be able to take advantage of tax loss selling. I will give you an example from our Canadian small cap research over the past year. Photon Control, it's been in our Focus Buy portfolio since it traded at 46 cents 5 to 6 years ago. We also re-recommended the stock in 88 cents just over a year ago in March of 2020. Mid-2021, it was acquired by another public company in an all-cash deal at $3.60 per share. The gains were between 200 and 700% for many of our clients. This is a great thing, but it triggers significant tax loss or tax consequences. Now, on gains like that, you should never begrudge paying taxes. Capital gains in Canada are far less than what you would pay on regular income. If you can offset those gains with some past losses and reduce your taxes, why not? That is where tax loss selling or harvesting comes in practice. There's things you should avoid when considering this strategy. Now, never sell a stock just to create a loss. While you may want to avoid the tax man and offset gains made during 2021, a decision made just to avoid taxes without the thought to the underlying investment is poor investment strategy and can often be regrettable in the long term, costing you more. Now, so the summary really is a stock at a loss in your portfolio is not the sole criteria for utilizing tax loss selling in your portfolio. Now let's look at when to use tax loss selling. Now, first, of course, you need those gains. You need to have significant gains. We established this above in the past 3 years. Without losses from the prior periods, loss carry forwards you can already use from past stocks you have sold at a loss. Now, this is key here. Take advantage of tax loss harvesting only in stocks you are already planning to sell as a result of your ongoing investment criteria, whatever that is. We believe that criteria should include you want to sell businesses where the fundamental criteria for your original purchasing the stock, your decision to purchase that stock originally, has changed, including deteriorating fundamentals, financials, strategy, or changes in the business, etc., that don't align with the reason you originally bought the stock. Do not sell good businesses that trade at a loss just to reduce a capital gain in 1 year. Now, while many of you are already familiar with tax loss selling or harvesting in reference to stocks, if you are not or needed a refresher, I trust that will now suffice. Having said that, we are not only here today to deal with the mechanics of tax loss selling, but rather with the opportunity it may provide for savvy investors this coming December, the period we're in now, which is right now, essentially. So let's get to that. What is the opportunity here? You want to take advantage of irrational selling. Investors with an eye to reducing taxes, doing exactly what we said not to do, selling shares in companies indiscriminately. They sell because they are in a loss position with no mind to the current value of the business. While not always the case, this can temporarily depress the price of good long-term businesses in tax loss selling season, right where we are now, mid-December into right around before Christmas. The exact time can vary, but it's in that range. So what should your goals be in this period? Buy good businesses with reasonable financials that face tax loss selling. These are the proverbial babies that get thrown out with the bathwater. What you should avoid, poor businesses with declining to no financial position that face tax loss selling. Remember, just because that stock that you're looking at was at $30 earlier in the year and now is at $9 or $7 today, it does not mean it is on sale. Many stocks will be sold in tax loss season for a very good reason. They are terrible investments. That $6 stock that was $30 is not necessarily on sale if it's a poor business. It can easily drop to $3 in the coming year if it continues to underperform fundamentally. An opportunity may materialize in 2021, but it may not. The strategy we're talking about today, however, can be tested and potentially used every year as another tool in your toolbox to help you beat the market over the long term. Knowing when to use it is key. It is often best used in a year when the broader market is down after significant gains in a prior year or multiple year period. So this is not necessarily the case in the broader market in 2021. So why do we think there is an opportunity in 2021? Now, we actually saw broader gains in larger names, but declines in specific areas after an earlier run. So that's the area we're going to focus on where we think we can see some babies getting thrown out with the bathwater. So we look at number one here, we see potential gains in the market. We've seen those. The NASDAQ, for example, home of the largest tech and many of the growth stocks in the US. The recipe here, you got those broader gains, significant gains can be achieved. We have seen this with our recommendations. We don't just recommend small cap stocks to build your overall portfolio. It's part of the component, but we have recommended over the past 10 years, companies like Alphabet, Microsoft, Fortinet, EPAM, and others. Now we're seeing 100 to 500% gains in many of those names over the past 1 to 3 years. The smaller cap names that we've owned for significant periods of time, including the Boyds, the Expels, the Aritzia, Sangoma, Photon Control, which we talked about, MTY Foods, and more, Investors now want to offset some of these gains and pay some lower taxes if they can in their portfolio. So you see here, they've been good gains to book over the past year and even over the past 10 years if you look at the market. Now, the subset of the market which is sold off here that we're going to look at, these small and micro cap companies that we've seen been hit hard in the second half of the year. You can see that many of these names and emerging growth names in technology, healthcare, gold, and metals, many in this segment hit euphoric highs early in 2021, particularly in February, March. Companies pushed far behind or beyond their underlying fundamentals in euphoria and have sold off since. The smaller rally at the end of this primary that you see there, and it's tapering now a bit, was really powered in Canada and on this exchange by the S&P Energy, or the Energy Index, oil and gas stocks, which has had a bump. And you can see this here. Now, pull out this energy sector and mining slightly out of this chart, and the drop is far higher. Before you start running out to buy energy stocks, so let's, if you look at how the energy sector has performed in Canada over the last 5 years, energy sector is down 17%. The entire sector over the last 10 years or 20 years, I think it's down 45%. It's been a terrible place to invest. You can get a pop in given years, but these highly cyclical industries are not where we'd point you towards. You juxtapose that to where we've been investing, some of the less cyclical companies in the Canadian information technology sector. 5 years in that sector, up 315%. You look at 20 years in that sector, up 670%. Tremendous gains there. Less cyclical names are where we would look for the long-term gains in the market. Not looking at the energy sector really right now as a long-term driver. What we've been able to take advantage of is good companies. What we can be able to take advantage of now, and the opportunity are some good companies that were pushed higher in a euphoria like we talked about in March, February of this year, and then can be sold indiscriminately in December by short-term industry or investors without an eye to the long-term intrinsic values of these businesses. There could be some good entry points here. It's not a guarantee, but we'll be watching it closely. Many were driven higher by overzealous investors speculating on these companies earlier in the year. I can give you a watch list now and examples of companies that'll illustrate the companies that we're looking for. Highs earlier in the year, significant declines today. I stress these are not buys. We'll get to those in a moment. Just examples of specific segments of the market that we're looking for, stocks that we're monitoring that got way ahead of their fundamentals and may have and see some attractive entry points in December. We will reject far more of these than we buy, if any. So let's look at the first company we're looking here, WeCommerce. So you see the chart follows the path that I was talking about there. So what does this company do? They focus on the Shopify universe by investing in or buying existing Shopify businesses that provide merchants with a suite of e-commerce software tools to start and grow their online stores. It IPO'd effectively late December around $7. It never really traded there, jumped to ridiculous near-term highs in the $30 range in January, February. The company has seen its share price drop around 59% since. It's an interesting business. Revenue's growing, EBITDA and cash flow are positive, but it's still not cheap. It trades at 43 times EV to EBITDA. That leads to the question of what it was doing and what the multiple would have been when it was trading at $30. There's organic growth outside the acquisitions, but it's tough to gauge given all the acquisitions and the noise in the business. We monitor it, but you can see the huge run up and the huge drop. It may come under pressure again during this period. And we say it's trading at still high valuations right now at present time in the market. So the next company we're going to look at is Emerge E-commerce, ECOM, on the Toronto Venture Exchange. Similar type chart there. Big jump in 2021 to highs at the start of the year, not warranted by underlying fundamentals. 56% drop from its highs. The company, what does it do? They are acquirer and operator of direct to consumer or D2C e-commerce brands. They just emerged into EBITDA positive territory, which is good. There's great revenue growth here, but it's still not inexpensive. It would fall into a category for us that it has to fall further before we'd really be interested. Another business that we know well, no pun intended, is Well Health Technologies. It's a technology-enabled healthcare company, virtual and traditional patient services in Canada and the US. Huge growth from acquisition. In fact, the company purchased one stock that we recommended in the past year and a half. The company was called CRH Medical. So there's aggressive growth, and adjusted EBITDA growth is tracking very well. It's an interesting story, but with the amount of recent acquisitions, the business is a bit messy, and tracking growth is a little bit of a challenge. There is a good management team here that we like. We like to check off that box. They've been successful growing a business in the past and selling out for a good exit point. Well is trading at about 3.5 times EV to revenue, which is below its peer average, telehealth peer of about 7.2. It is at a premium to the average primary care or omni-channel peers. It still trades with an EV to EBITDA of 27, even after the drop. But if you look forward over the next year, it likely drops to around 15. So it is getting into a range that is more attractive. The next company we're going to look at here is a company that is cash rich. We like businesses that have good, solid cash balances. Follows the same pattern on the chart there you see. New business, public business. It's been around for decades as a private entity. It's called High Vision. They provide low latency, real-time video streaming and network infrastructure solutions, primarily hardware, but there is a growing software component, and that is more of a SaaS related business that we like as that grows over time. Cash rich. They did miss revenues in the last quarter, but if the drop in this stock continues, they may be interesting. Right now, they're trading at about 11.5 times this year's expected EBITDA, which is interesting for us. Of note, this company has some high profile customers. They actually, during COVID, the NBA did a draft that was virtual, their last draft. That was all handled by HAI systems. So pretty high-end customer base that they have as well. Niche, but high-end. Last company we're going to look at here is BioSynt. It's a business that is cash rich, profitable, specialty pharma. It has the best-selling OTC iron supplement in Canada. Other smaller products bringing online into the Canadian market. It needs to diversify its base, but if the company can replicate the success it had with this product and bring one or two more online that can equal that product, it would deserve a higher multiple. This stock may be 12 to 24 months away from really proving that out, but we don't want to get too cute on it. In this current range, about 20% of its market cap in cash, significant cash there. We think it offers growth at a reasonable price if you're looking 2 to 3 years out. We wouldn't actually be surprised if earnings went down slightly this year, but we think it could be a buying opportunity either in this December period or over the course of the next year. So let's move to some recommendations from our list. And I'm going to summarize here, first of all, then we'll move. Sorry, I will summarize. We want you to take advantage of irrational tax loss selling. Temporary depression of good businesses can be an opportunity. The goal is to buy those good businesses with reasonable fundamentals that face tax loss selling. Avoid the poor businesses. There are many businesses out there that will get sold ruthlessly in this period that deserve a spanking, and they should continue to be spanked over the course of this year. Let's look at the first company we're going to look at here. It's Dynacor Mines, symbol DNG on the TSX. It's been in our coverage for a number of years now, since it traded about the $1.80 range. It's $2.78 now. It pays a good solid dividend yield, just $108 million market cap, so small cap definitely. What does the company do? They're a dividend-paying industrial gold ore processor. The company is engaged in gold production through the processing of ore purchased from ASM, or artisanal small-scale mining industry, primarily in Peru. Now, what does the profitability depend on this business? Two things, really. A margin between the price of ore purchased and the market price for gold. The higher the margin, the better. In a rising gold price environment, typically it does better. The throughput is a big thing for this business. The amount of ore processed, essentially, the higher the throughput, the better. A higher gold pricing environment encourages more small-scale mining, which grows Dynacor's ore supply and creates a more profitable growth business. That's what we've seen over the past year, and this is why we like the business. They recently pre-announced revenue guidance. They upped that again. Projected sales for the year are between 185 to 190 million US. Again, their market cap in Canadian is 109 million. And you're talking about a company that we believe in Canadian dollars, because its market cap is Canadian dollars, will do over 250 million in sales this year. It amounts to an increase, this upped guidance of 25 to 35% from guidance that was already up 50% over the previous year. So strong guidance that was already up. We expect net income this year of 29 to 32 cents per share, based on a justified multiple of just 11 times that, and we add back the 43 cents per share in cash, we get a target price or a fair value for us in the range of $4, significant upside from where it is now. Again, Q3, tremendous growth in this business. There was a dividend that was up 25%. It was already upped in Q2, 33%. So we do note that Dynacor, because of where it operates, holds well above geopolitical risk. Keystone owns shares in the business as well. We note that. QIPT Home Medical is the company we'll talk about. QIPT on the TSX, symbol QIPT, $7.85, doesn't pay a dividend, $265 million, $262 million market cap. What does the company do? It's not just a symbol, QIPT. We always like to point out these businesses have operations. Don't buy it because it's a symbol. What do? They provide in-home monitoring and disease management services, including end-to-end respiratory solutions for patients in the US healthcare market. Offerings include the management of several chronic diseases. COPD would be one, focusing on patients with heart, pulmonary disease, sleep disorder, reduced mobility, other chronic conditions as well. They operate largely on a subscription-based revenue model, which we like. And we love the business over the long term based on the demographics there. They grow organically and through acquisition, having made 12 acquisitions over the past 4 years, 4 of those in the past month. So it's really picked up the acquisition pace, and we think that'll add to growth over the next year. Why do we like it? There's strong profitable growth here. If you look at Q3 revenues up 43%, 7% organic, 34% acquisitions. Adjusted EBITDA up 21% in the last period as well. Near-term fair value, if we just give it an EV to EBITDA of around 10 times its run rate, $10. So upside on the company too, if it receives more of a peer equivalent multiple of 12, which we believe will be justified given on the growth execution here. And we see the margin profile increasing. The next company we're going to look at is Trulieve Cannabis. Owned this stock since it was in the $13 range. One of the only cannabis companies that we've ever owned. $35 now, doesn't pay a yield, $6.4 billion market cap. What do? Well, Trulieve is a vertically integrated company, multi-state operator, seed to sale, operating. Florida is their biggest market. They own 50% market share in that, what is a medical cannabis market right now, but they're also in Arizona, Pennsylvania, 11 states now, 156 retail operations. Recent acquisition creates more of a true MSO. They were kind of pigeonholed as a Florida-centric company. They've got 3 hubs now. We'll show that on the next slide. 3 hubs, the Southwest hub, the Southeast hub, which they're huge in, and the Northeast hub now. Truly becoming more of an MSO than they ever were in the past. They industry-leading scale through this acquisition. You see Harvest and Trulieve pro forma. In terms of revenue, basically on par with the leaders in the industry, but in terms of profitability, the most profitable in the sector by far. We've interviewed the CEO many times. One of the things that attracted us to the business is that they have never contemplated running the business unprofitably, as many have in this segment. So we like that. We like profitability. You can see here at the multiple on Trulieve relative to peers, significantly lower. We like to buy businesses that are leading in terms of profitability. And if you can buy them trading at a discount to peers, that's something we truly like. So the combined entity adjusted EBITDA guidance around 461 million US. So that's strong growth. Trulieve is trading at approximately 10 times that forward EBITDA. Long-term fair value, if we give it a 16.5 times EV to EBITDA just over the next year, 55%. That's growth at a reasonable size price. Again, we reiterate that the cannabis sector remains high risk. In terms of Trulieve, Keystone does own a position in the company. Now, the final company, I think this company is actually presenting at the event. Geodrill, symbol GEO on the TSX, around $2.07 trading, does pay a dividend, just under 1% yield. So returning capital to shareholders, what we like to see, just over $100 million market cap. What does the company do? A leading drilling company with a large presence in West Africa, emerging presence in Latin America. 71 drills as of the last quarter, up from 67 at the end of 2020. It's expanding its geographic presence into Egypt and North Africa and Peru and in South America. Now, why do we like it? Well, it's a unique way to gain gold exposure without the level of risk associated with gold miners or developers at a fraction of the valuation to its peers in North America, Australia, and Europe. The outlook remains strong as higher gold prices and exploration co-financings drive drilling activities. So that's the rationale behind looking at the company. We've owned it since it traded about the $1.60 range. There's strong profitable growth here. If we look at estimates for this year, 114.4 million US. On a cash flow basis, Canadian 0.64 or 64 cents. Fair value based on the multiple of about 4.25 times cash flow would be $2.75 to $3. So significant lift from where it is now. We think it's growth at a reasonable price. We've owned shares since it traded again in the $1.60 range. We like it over the course of this year. It's dependent on the price of gold price and sentiment there, which we steer clear of for the large degree. But if it does have a supportive to existing gold price range over the next year, there's a lot of money driving into that segment. And this company should be able to start to gain some pricing power as it goes forward. And we expect good solid growth for this year, tremendous growth for this year, and good solid growth going into next year. And that's what we look for in the companies that we invest in, growth at a reasonable price. So as far as the watch list that we highlighted today, Keystone existing right now has no positions in any of the names we mentioned there, other than a small position in Biosynth RX on the TSX venture at present. Again, I'd like to thank everybody and wish you all profitable investing. If you want to come by our website and check us out, www.keystocks.com, ask your questions there. Thank you very much, and thanks for having us, Bobby.